Now, April inflation, of course, out, and it's a surprise to the downside. The Philippine Consumer Price Index again slowed 1.4%, its lowest level since November of 2019. Markets are now digesting what this means for the Bangko Sentral's policy, the country's credit standing, and the overall growth outlook. Joining us now for a quick reaction to this is Christina Ulang, the head of research at First Metro Investment Corporation. Hi, Christina. Always good to have you with us.
Hi, good morning, Mikey. Thanks for having me.
Okay, Christina, let's start with your initial take. April inflation at 1.4%. This came in well below expectations. What was your initial reaction and what stood out the most to you in the breakdown?
Well, this is a nice beat. Very, very nice beat. Positive surprise and a big catalyst for our PCA, which is we have seen it rise recently. We have a rally, but of course corrected yesterday. And this is really very, very has positive implication also for the BSP, cutting the rates in the second half. The 25 basis points cut next June, in the next June meeting of the Monetary Board, already in the bag.
Yeah,
Seems to be already in the bag.
For June, a 25 reduction in basis points already in the bag. What about for the balance of the second half? How much in total, given that inflation has been, given that we have disinflation, it's been going down every month since the start of the year. Right now, it's at a 4-year low. How does this change your expectations for the balance of rate cuts for the full year?
Well, we are living in a world filled with uncertainties coming from the U.S. tariffs. China is suffering from a very high tariff of like 145%. We are not exempted. Our negotiators are there already in Washington, hoping that we can have some accommodation. We can be accommodated for lower tariff and then greater market access. And so this is a period of maybe growth at risk. The scenario is that our GDP target of 6% could be at risk, and therefore the BSP, I think, is going to be very, very pro-growth, trying to stimulate the economy, will attempt to stimulate the economy further on top of the 25 basis point that they have done, the rate cut that we've seen last April 10, maybe another 50 basis point cut in the second half, or maximum of a 75 basis point cut on the aggressive side, just so we are able to hit the 6% GDP target for the year. Of course, there are other ways to stimulate the economy, but maybe the monetary policy can do the heavy lifting.
Yeah, the monetary policy would do that. 50 to 75 basis point cuts going to help us substantially, especially as growth expectations keep being revised lower. Moody's Analytics just pegged Q1 GDP at 5.5%, for the full year 5.9%, which is below the expectations of the government, which they want GDP within 6 to 8%. What are your thoughts for full year GDP this 2025, Christina?
Full year, we should be close to 6%. Our initial target was forecast was like 6%. But this tariff war, this trade war, is actually already a trade war, is reducing business confidence globally. Of course, the foreign direct investments could be at risk, and then taxes and growth targets may not be met. And therefore, we have revised our GDP target, GDP forecast to a little lower than 6%, 5.8% for the entire year.
It's also worth mentioning, Christina, that the low inflation we had for April, 1.4%, a lot of that is also because of weakness in the U.S. dollar, which helps support the peso. Our peso, our currency, has been doing pretty well. Can you talk to us about the balance, how weakness in the dollar means strength of the peso, and how it translates to lower inflation, just as we saw this April?
It's really one of the factors that affect our inflation, and it usually is like this. The sensitivity is like for every 10% depreciation, the currency, for every 10%, there is this correlation of like 70 basis point gain on the part of the CPI for every 10% appreciation of the currency. So it's really very favorable that the dollar is weakening and that the peso is strengthening. And it's not only the currency. We're seeing global commodity prices also collapse. Oil is down like 12%, 13% year to date. And then grains, rice, global rice prices is also down negative 20% year to date. And this backdrop of falling commodity prices are very helpful to the inflation outlook going forward. But the key worry, given that inflation is stable and decelerating, is really growth. How is this a global recession warning from the IMF going to affect us? But hopefully we are least affected because our trade really is just very small. Our exports to the US is 2.8% of GDP, and our total exports to GDP is only 12% or 13% of total GDP, our exports. So we're least affected, and we have a lot of domestic drivers for GDP to achieve 5.8, 5.9% this year. Of course,
Okay.
household spending.
Yeah. Okay. Christina, with April inflation falling to just 1.4%, a four-year low, is the economy flirting with deflation? Right now, we are in disinflation, which is a slowdown in the prices. We're not at the deflation point. What would bring us there?
Mhm. Well, the only deflation that we're seeing is the one of rice prices, because it's now down negative 10.9%, coming from negative 7.7% last month. So it's in the negative territory, and it keeps on falling. But it's only that commodity plus corn, of course, that has seen negative growth in terms of the price movement. So there's this theory that if China goods are unable to enter the US because of the high tariffs, they may be going to markets elsewhere, like for instance, ASEAN, Southeast Asian nation, including us. These products, given the huge excess capacity of China that may be created by the high tariff barriers in the US, it may force the deployment of this excess capacity to Southeast Asia. And we may see a deluge of goods coming from China into the Philippines. And that may be, in some opinion, is there saying that it may be deflationary. And that is something I think government will have to work on in terms of erecting the proper barriers for this potential dumping of excess goods coming from China into Southeast Asia or into the Philippines.
Okay, Christina, in terms of asset allocation, given the low inflation and the easing bias from the BSP, where do you see the most attractive investment opportunities right now? Is it in bonds, equities, or real assets? What's your take on this?
Mhm. Equities is making a resurgence because we have a combination of three factors. Number one, we have the strong peso, which we have seen in 2019 when the PISA did a triple top at 8,200 in March, and then in July it was at 8,100. So that was one strong peso. We saw that in 2019, and it's now happening today. And then low inflation also, it's 1.4 now, and it was like a zero point 0.5, very low during that time in 2019. And then also we have growth then, but higher at 6%. So we still have decent growth now, and our corporate earnings are meeting expectation. The banks are lending very vigorously and are showing good earnings, like 9% for BPI, Metrobank 4%, and then BDO is like 7% growth. And all of this means that the equities market is very well supported. And given the low valuation, 9 times PE, then there is a lot of room for bargain hunting and for foreigners to come in and buy Philippine equity. So that's one side of the story. But fixed income is also very attractive because interest rates are expected to fall. The BSP might cut by 50 basis points. So that's going to have create upside for on the price side. And at the same time, we have this very attractive yield in the long end. The 10-year benchmark that was recently floated by the government fetched a high of like 6.3%. So it's very attractive, and given the decline in interest rates, it will improve the total return, both from the coupon side and from the price side. So you have two assets, and of course of course the FX market also benefiting. Strong peso, equities markets resurgent. Foreigners are gonna come in, and then a fixed income also.
Yeah, with a peso nice and attractive. Okay, Christina, lastly, what's your word, what advice can you give to investors trying to navigate today's macroeconomic environment? We've got lower inflation, lackluster GDP, the BSP on an easing cycle, but external risks like, tariffs are still in play very much. What's your word of advice for people navigating today's environment?
Mhm. Of course, we are living in a different era. This is the era of trade war. Tariffs are not going to come back to the levels that they were before because this is the era of Trump, and the US is trying very hard to contain China, trying to erect tariffs so that they will be able to rebalance the trade deficit that they have, very huge trade deficit that they have with the other countries, and also encourage the reshoring of manufacturing because their manufacturing firepower and prowess has really declined and been damaged by the strength and the success story of China. So it's a different world. And I think we should take advantage of the volatility. Volatility is our friend. We will make money from the volatility of the equities market. And there are very, very good companies in the Philippines, really. Resilient banks, resilient energy companies, high dividend paying stocks, and of course REITs, not to be forgotten because of the interest rates going down. And so if you have equities, try to do your selective, high selectivity posture when it comes to equities, and then also accumulate fixed income in the long end, of course, so that you are able to lock in this very attractive 6%, 6.2% yield on your plus the price appreciation so that the total return is further enhanced. So really, we are seeing very good opportunities in both the fixed income market and equities market.
Yeah, I love the way you frame that. We are very resilient, nationally and economically. Thank you so much for your time, Christina, the head of research of First Metro Investment.
Thank you, Mikey. Bye-bye.